All right, I think we'll get going. So tēnā koutou everyone, and a very warm welcome to you. My name's Cath Lomax and I'm the Chief Client Officer here at Fisher Funds. And it's great having you join us today. So for the webinar today, I'm joined by two of our very experienced advisors. So we've got Victoria from Auckland and Nick from Christchurch. And we've also got one of our investment team here, Robbie, so welcome. And Robbie is one of our senior portfolio managers running the Australian Equities. So we're currently in the middle of Money Week, which is a great initiative, and it's all about having money conversations and getting familiar with all of things financial. So, and that's something I really truly believe in, and I have a lot of conversations with my children in particular about money and explaining how it works, particularly around investing and KiwiSaver and also their spending. So as one of New Zealand's largest investment specialists, we have hundreds of money conversations every day with our clients. And so what we thought would be really good is come to you today with a webinar and explaining some of the most common questions that we get and some answers for some of those. So before we get started, a couple of things just around the webinar. So your attendance isn't visible to anybody else. Today is information only, it's not financial advice, so it doesn't take into account your own financial situation. But as you know, you may have an advisor, or we've got a team here at Fisher Funds that can help with any of your questions. So please feel free to ask those or contact us anytime. And the other thing is the webinar is being recorded, so you can share it with family and friends later on. So we do want to answer your specific questions today, and we've already had some come through, which is fantastic, and we've used the presentation today to be shaped around those. But if you see down the very bottom of your screen, you'll see a Q&A button. So please feel free to type in your question and we'll do our very best to answer them. And if we don't get them to you today, get the answer, then we will come back to you with that. So please ask the questions. So actually it leads me into one of the first things that we get asked, and into the first question, which is who can I talk to? And so I'll answer that. So money conversations are really important, and it's never too late to start the conversation. I think discussing with family and friends is a really good way to kind of get over the barriers of asking those questions that sometimes you can be a little bit embarrassed to ask someone about. And as I mentioned earlier, that's something I really love to have those conversations with my children and talk about money and saving. And I really want them to ask me all the questions that they might want to know and really help them for their financial future. And we've seen a huge increase recently in social media content around cryptocurrency, KiwiSaver, investing. There's a whole lot of terms being used. And while it's great to see all of this content in there, it's really important to understand who's giving that advice and who's giving you that information. So really important to think carefully about that. And sometimes it can be easy to get sort of swayed into the something that's going to give this most amazing return and time the market, which sometimes can do more harm than good. And at Fisher Funds, we really believe in having access to information and access to advice. So we've got advisors in Auckland, Wellington and Christchurch like Nick, and they are able to discuss your goals, your KiwiSaver or your investment strategy. So feel free to contact us. Now, Victoria, I'm going to start with you. One of the great questions that we often get asked is, around KiwiSaver contributions in terms of the government. So can you share a little bit of light around that for us?
Yeah, absolutely. So do you remember when you were little and you were saving for something and your mum and dad said to you, for every dollar that you save, I'll match you $1? And that helped me into my first pair of roller skates and my first bike, because it was such a great incentive, because it helped make that end goal seem much closer and the progress was satisfyingly faster. Well, for KiwiSaver, the government contribution is exactly like that. The government will give you 50 cents for every dollar that you save, up to the value of $1,042.86 per annum. So that equals $521.43 in matched savings every year. There are certain criteria that you do need to meet to qualify for the government's contribution. So you will need to be over the age of 18 and under the age of 65 and living mainly in New Zealand at the time. But don't let that deter you from setting up KiwiSaver accounts for your children, especially once they get a part-time job. It's very likely that their employer will be contributing as well. And so that helps them build up some fantastic savings so that when they come to buy their first home, they've already got a substantial little nest egg there, because it can't overstate enough the value of time that has on this investment. It's always one of these things that we say that, it's not timing the market, it's time in the market. So that, in keeping with that KiwiSaver theme then, another common question that we get is, which KiwiSaver fund should I be in? So the general rule of thumb regarding strategy is the closer you are to needing the money from the investment, be that the first home purchase or indeed commencing retirement withdrawals, then the more conservatively you should be invested. So a conservative fund is designed to protect and preserve the investment, whereas a growth fund is designed to do exactly that, to grow. But with that growth comes an increased exposure to volatility. So it's therefore better suited to a longer time frame, anything greater than 5 years, which allows for those bumps along the way to be smoothed out. And we generally refer to this as a long-term strategy. So the next slide that we're going to look at highlights exactly what a tangible difference the right strategy can have on your KiwiSaver. So this slide is based on someone starting full-time work at 23 with a salary of $35,000. We've made a couple of assumptions here. One, they get an annual pay rise of 3.5% until they turn 65. Two, that they contribute 3% to their KiwiSaver scheme after tax, and their employer also contributes, but that's 3% before tax. We've also assumed that the government contributions are made annually and no withdrawals are made. So what you can see from this graph here is that the conservative fund on the left-hand side has returned 2.5% after tax and fees each year, and the growth fund has returned 4.5% after tax and fees each year. All these dollars are in today's dollar amounts. We've also made an assumption about inflation, annualized that at 2%. So you can see quite clearly the one on the right-hand side is substantially bigger, 51.5% higher. And this harks back to that comment I made earlier about time in the market. You may have heard this, compounding interest is the eighth wonder of the world. Well, the same thing goes for compounding growth. So I guess something that's come up a lot this year for us, particularly with all the volatilities that we've seen in the markets, is KiwiSaver clients coming to us in a little bit of a panic and asking if this is a good time to change their strategy from growth to conservative. So first question then, if volatility is the only concern that they have, and they aren't intending to make that first home purchase in the next 5 years or commence retirement withdrawals in the next 5 years, then the answer is an unequivocal no. Look, it's natural to be concerned, but KiwiSaver is a long-term investment, and as long as you've got that 5 years, then it's really important that even during these volatile times, you stay the course. By remaining in a growth strategy, you're best placed to benefit when those markets recover. And believe me, they will recover. In fact, they're already starting to do so. So if that withdrawal is less than 5 years away, it would, even if it is, it would be preferable to move, say, the portion of your investment that you're going to need in the next 2 to 3 years to invest conservatively and leave the remainder in a growth strategy. And the primary reason for that is because you need to give the investment time to recover and to capitalize on that market recovery as well. But also, retirement is a long game, and in order for your KiwiSaver to support you throughout your retirement, an exposure to long-term assets is going to be necessary. As always with these things, risk tolerance is actually more about timeframes, isn't it, Nick?
Yeah, that's exactly right. In fact, we've all certainly had our appetite for risk tested in the last 6 months. So what I'd encourage you to do, if you've been feeling really uncomfortable lately, it might be a really good time to have a chat with your advisor about your personal situation and just ensure your current strategy is actually appropriate for where you are. And again, as Vic's already alluded to, if you have a longer term time horizon, maybe more than 10 years before you need or able to access the funds, then having an adequate exposure to more growth oriented assets like shares and property is quite important in order to try and outpace inflation over that longer period of time. And that kind of leads me into another common question we hear regularly, which is, I'm approaching retirement. What sort of changes should I make to my KiwiSaver? So it's quite an interesting question, and it has a bit of a multi-pronged answer, really. First of all, you need to consider how you're going to use your KiwiSaver investment during retirement. Are you going to drip feed it out to top up your other income sources, like New Zealand Super, for example? Maybe you're planning to take occasional lump sums for holidays, caravans, cars, boats, things like that. Or maybe you don't need it at all, and it's just going to sit there as a nest egg for your estate. So regardless of how you're planning to use it, it's definitely worth having a chat with someone, your advisor ideally, so that you can make a bit of a plan, because each scenario could make one strategy more appropriate than the other. Now, we're able to create some projections for you, run various scenarios so you can see how your portfolio may look in the years ahead. And lastly, checking on your strategy annually is really highly recommended. So we like to conduct an annual health check on our KiwiSaver, but like doing a Warren Fitness on your car, it just ensures your overall strategy remains appropriate for your personal situation.
Great, thanks, Nick and Victoria. That's excellent. So I can see already that we've got loads of questions coming through about KiwiSaver, which is fantastic, and we'll get to those after the presentation and some of the questions that we've received already. And I want to touch on managed funds. We've heard a lot of tips around KiwiSaver. What is managed funds? And I know it offers a little bit more flexibility than KiwiSaver, but it would be good to understand a little bit more about that, Nick. So can you help explain what is a managed fund?
Yeah, absolutely. So in a nutshell, a managed fund is a professionally managed investment fund that pulls together money from many investors and then invests that money into various assets like shares, property, bonds, and cash. Now, managed funds are quite similar to KiwiSaver in how they invest these funds, which is a well-diversified spread of these assets. But the main difference, as you've mentioned, Kath, is the flexibility of access to these funds. So with KiwiSaver, you're able to withdraw your funds for your first home, retirement, or other various adverse life events, which hopefully aren't going to happen to you. But with managed funds, you have access to these funds for any reason, really. So they're a great way to grow your wealth over time with a lot of flexibility built in, just in case life throws you a bit of a curveball, as it does from time to time. One popular example of how managed funds can be used would be for children or grandchildren's education. Going back to Vic's earlier comments on the effects of compounding over time, contributing a regular amount while they're young can potentially lead to quite a sizable sum by the time they reach university age, or maybe even earlier if you're considering private schooling. Another potential scenario, you may be considering early retirement, in which case you're going to need access to your funds before 65. So this is a kind of scenario where a managed fund may be an appropriate option to divert some of your surplus income into.
Yeah, great. I agree. And I think having options of both KiwiSaver and managed funds is something that I've talked to my children about. And also I've got myself for their education as well. So obviously have a chat to us if you've got some questions about that or you want to find out more. And one of the team here at Fisher Funds or your advisor can help answer any of your other questions around those as well. So Robbie, you've been sitting there very patiently. So welcome. I know you've spoken on this topic before, but every week we have conversations with people who they're saying, I'm looking to invest, but I'm going to wait for the market to be perfect. So when is the best time to invest?
Thanks, Cath, and good afternoon, everyone. Thanks for joining us today. Cath, the short answer is now is the right time to start investing if you haven't already begun investing. And to your point, it never feels like a great time to invest. You know, honestly, even when markets are roaring away and the world feels like a great place, it's easy to be concerned that you're going to pick the top and then a downturn will be imminent just after you invest. And similarly, if you go through a period like we've had in the last 6 months where the world is awash with negative headlines. The cost of living crisis is sort of front and center for everybody. Markets have been going south and falling. It can feel like a really uncertain time to invest. The point is that I think if you just start investing now, irrespective of whether markets are rising or falling, and adopt a decent time horizon in mind when you invest, and hang on for an appropriate time period, longer time period, things should turn out okay. And to illustrate that point, if we just pull up this chart, which shows the returns on the US market, on the S&P 500, which is the key index on the United States share market. And this shows that if you had invested, for example, $100 back in 1980 and hung on until today, that would have been turned into about $11,000 today, which equates to a 12% return per annum since 1980. Along the way, you would have gone through the Black Monday crash of 1987, which was a huge event in the 1980s. You would have gone through the first Iraq War. We would have had the massive dot-com crash in 2000 and the huge financial crisis that we had back in 2007 and 2008, where the market fell 50%. Obviously, you would have gone through the COVID pandemic sell-off that we had a couple of years ago, and still you would have come out really decently ahead. In fact, even if you got your timing way out in terms of picking the top of a market and invested right at the peak in 2007, just before the onset of the financial crisis, you still would have had made 3 times your money between then and now if you'd hung on. And that's the key. So, Vic and Nick have both alluded to this. It's important that when you start investing, you put a program in place that allows you to ride these traumatic periods when markets sell off. And if you can do that and have an appropriate investment plan in place, things should turn out okay. But to come back to your question, Cath, people, if you're not invested, you should really think about doing that now.
Great, thank you. Now, Robbie, I know ESG, and I'll get you to explain what ESG is a topic that a lot of investors are really interested in. Every single webinar, we get questions about it. So can you give us, just explain about what ESG is, and I guess reassure or tell our audience today a little bit about how do we know we're not investing in companies that do harm?
Yeah, so ESG is an acronym that stands for environmental, social, and governance issues, and it really reflects the non-financial metrics that we use to analyze whether companies or investments that we make are they doing good or are not serving I guess the environment well, the social community well. Our company, from a social perspective, are they doing right by their customers, the communities that they operate in, their employees? Do they have good governance structures in place, or is that is that not well structured? So you can, from a fund manager perspective, if you want to know what the fund manager's approach to ESG is and what they're investing in, and very importantly, to your point, Cath, what they're not investing in, you can go onto their website and normally look for what's known as the responsible investing policy part of the website. And that should detail quite clearly what a fund manager's policy is when it comes to environmental, social, and governance issues. And if we take Fisher Funds for an example, if you went onto our website and landed on our responsible investing page, you'd see that we've got a couple of planks to our responsible investing policy. The first is we have a number of sectors and companies that we just won't invest in, period. Companies that we think do harm, and we won't have any of them in any of our portfolios. And so for us, this includes companies that manufacture tobacco, companies that manufacture nuclear weapons, and produce thermal coal, for example. There are a few other sets of exclusions that we have at Fisher Funds. Allied to that, we also have quite a strong engagement policy. The world is clearly, it's quite easy to demonize companies and people and just split them into 2 camps, good and bad. The world is not like that. We all know that. There's a lot of nuance and gray area that sits between. And to deal with that gray area, as an investment team, we engage with companies, we speak to them about what they're doing, apropos the environment, the people that they work for, for social perspective and so on. And if we're not happy with what they're doing or we think they're heading in the wrong direction, we will pressure them to change tack and move in the right direction. And as shareholders, because we run funds and own shares, we have the ability to ratchet up that pressure by voting our shares at AGMs, and we can put pressure on companies that way. And then ultimately, if you just beating your head against a brick wall, we can also obviously sell our shares. But engagement is a really key part of that for us. So I counsel for people trying to understand what their funds are invested in or not invested in from an ethical perspective. You should be able to find that out from website or speak to the fund manager themselves. They should be able to articulate that quite clearly.
Yeah, that's great. Thanks, Robbie. And a few of the questions what Victoria and Nick talked about earlier was a bit around volatility and what we've been experiencing, particularly in this last year. Typically, conservative funds tend to hold assets that sort of see moderate volatility. However, this doesn't seem to be the case this time in this latest correction. So why are we seeing more movement in our conservative assets?
Yeah, it's been a really tricky period for conservative portfolios over the last 6 months because of this volatility. And if we just think about, normal economic crises, if there is such a thing, conservative portfolios tend to have a higher mix of assets in a higher proportion of lower risk assets in the portfolio, namely fixed interest assets or bonds. And they have a smaller proportion of growth assets like shares and property, which you typically find in growth portfolios. And the reason for that is these low risk assets tend to act normally as an insulation against big economic crises. So when the world is going into recession and people are worried about a crisis that's emerging, typically we see bond prices go up, and it protects that part of the portfolio. And so conservative portfolios tend to hold up reasonably well in those sorts of circumstances. But what we've had in the last 6 months is quite different. It's quite an unusual setup where the cause of the economic turmoil across the globe this year has been driven by skyrocketing inflation, which has sent goods prices, and services prices, travel, restaurant services and so on. It's sent all of those prices up. The cost of living crisis is on everybody's lips at the moment. And with the rise of inflation, central banks have tried to combat that by increasing interest rates. And they've done that quite sharply. And in so doing, not only have share markets sold off this year and property prices have started falling, but it's also led to bonds and fixed interest prices falling as their yields have gone higher. So we've had this pretty tricky environment where the insurance contract, the fixed interest portion, has fallen as much as we've seen from shares. And so that's what's been negatively impacting conservative portfolios. But Cath, as much as the journey has been quite rough for conservative portfolios over the last 6 months, given where fixed interest assets are priced today, our view is that they're really attractively priced. And we've also seen some nascent signs that some of the worst parts of this inflationary period may be starting to ease. So we had the CPI, the inflation print, come out of the US last night, their latest one, and it buoyed the market because it was actually low. It was high, but it was lower than the market was expecting. So we've had that. We've also had, when we talk to companies that we invest in, they tell us that some of those supply chain constraints that has also led to increasing prices, they're starting to ease. And so hopefully, to the extent that we get more data points like that, we should see a stability return to the interest market, to where interest rates are, and that should be quite constructive for fixed interest assets and consequently for conservative portfolios. So in a nutshell, it's been a tough journey, but I think the outlook from here is quite a lot better when we think about where these portfolios may go.
Great, thanks, Robbie. And this is the last question for you before we go to the live questions. And really, it's sounding more positive. When can we expect the markets in general to pick up, do you think?
Yeah, the crystal ball question.
Yeah.
It's if you look at data of bear markets over time, the averages would tell you, Cath, that bear markets, generally it takes about a year, just over a year, for share markets to fall from peak to trough, and then another 2 years and a bit for them to recover and get back to their previous highs. But as you know, averages really mask, a range of sins, because every bear market and bull market has its own idiosyncrasies. So, if we think of the 1987 crash, for example, that was a really rapid crash. The market fell peak to trough in 100 days, and it didn't take much more than that to recover. Whereas in 2008, in the financial crisis, it took a year and a half for markets to grind down to fall 50% by the time it had hit the trough, and it took about 4 years to recover. But on average, yeah, it's about 2 years to recover back to previous highs from the trough. And I'd also just caution, if people tell you with precision and with certainty how long it's going to take for markets to recover, as Warren Buffett says, it tells you more about the forecaster than it does actually about the forecast. So, but what I do think is interesting is when we reflect on bear markets and how it transpires. If you look on this next chart here that we will just pull up, and this just shows a range of bear markets and bull markets experienced in the United States from 1948 until today. The bear markets and the losses that you would have got from peak to trough on your equity portfolio, shown in the turquoise bars at the bottom, and then the gains that you would have got if you'd stayed for the ride through the ensuing bull market that followed that negative period and turmoil. You can see that the dark blue bars are all far higher than any of the losses that you would have experienced during the bear market. So again, the key takeaway from me from this slide is that when things get tough and markets fall 20 or 30, or in the case of 2008, 50%, be really careful about selling out and trying to just reduce the pain, because you can quite easily miss out on a bull market, and those returns will be far greater than the drawdown that you have during a bear market. So again, it comes back to the point that Vic made. It's time in the market that's important. If you can structure your portfolio to weather the storm on bad days, you'll be there when the sun rises, and that's a far better period to work your way through, and things will turn out okay. So I would suggest people seek advice, speak to people like Vic and Nick, and structure a portfolio that allows you to be there for those dark blue line days.
Great, thank you. And Robbie, hold on to your mic for a few more minutes, because
Sure.
I'm going to direct the first few questions to you, and then I'll pass them over. So great to get some of your questions coming through, and as I said, we'll answer as many of them as we can now. So Robbie, New Zealand shares looking good long term. What's your view on that?
Yeah, Cath, if I think of the way that we run our investment approach here at Fisher Funds across all of our portfolios, whether they be in New Zealand shares or Australian shares or our international equity portfolio, we have a very strong focus on handpicking the best companies in each of those markets that are high quality businesses, have got strong, good economic moats around them, which enables them to grow and grow their earnings strongly over a long period of time. And so if I think about the New Zealand companies that are in our portfolio, we've got New Zealand stalwarts in there, such as Fisher & Paykel Healthcare and Mainfreight, and they are very high quality businesses. They have got long growth runways in front of them, and I think the outlook for them, as it is for companies in our other equity portfolios, is quite strong. So that's specific, I guess, to the New Zealand companies that we're invested in. But yeah, I think over time they should do really well. They're run by good people, and they're in a good position.
Great, thanks. And last question, and then I'm going to hand over to for some of the others to answer. Are we invested in New Zealand international equities and index funds?
Yeah, well, at Fisher Funds, we, as I think I've just alluded to, we have a New Zealand equity-only portfolio, Australian equity-only portfolio, and we have an international equity-only portfolio, and a bunch of, I guess, multi-asset portfolios have a combination of those portfolios in there. But we are not invested in index funds. We are, unashamedly an active manager. We think if we pick the best companies in the world in each of the different jurisdictions and put them into those portfolios, we'll do better than the index overall. So we don't have index exposure, but we do have exposure to New Zealand, Australian, and international equities. Yes.
Great, thanks, Robbie. Okay, Nick, I'm going to hand over to you. So, and this is a question actually that we do get quite commonly. So good one for Money Week. How do you start investing with small amounts? So hearing everything sounds really good. How do I go about investing, and can I do it with small amounts of money?
Yeah, definitely. As we've spoken about, the power of compounding on your side, even small amounts add up over time. So it's a great idea to make a start as soon as you can. So you can invest into our managed funds for as little as $100 a month. That works out to about $23 a week on average. KiwiSaver is also quite flexible. You can make voluntary contributions anytime you like. With KiwiSaver specifically, we normally recommend that anyone aged between 18 and 65 contributes at least $1,043 per year. That's in order to receive the maximum government contribution that Vic alluded to earlier. And that, again, that works out to be pretty much bang on $20 a week too.
Great, thank you. And I've got another question here, which is I'm over 65 and I have $20,000 to add to my KiwiSaver or a managed fund. Which is best, Nick?
Yeah, another really good question. Because once you're actually over 65, KiwiSaver effectively becomes a managed fund. So all of the withdrawal restrictions are removed and you're free to withdraw some or all of your funds, as well as set up regular drip feed payments if you wanted to do it that way. So in this situation, if you've already got a KiwiSaver in place, that could be a good option for your lump sum, as long as you're planning to invest that for at least a few years. In terms of the type of fund you'd invest into, this is where it'd be worth chatting with an advisor just to work out what your overall time horizon is, what your objectives are for that money. If it's money you're going to be drawing on within the next couple of years, then potentially a more conservative fund might be more appropriate. But if the funds are earmarked for, say, inheritance purposes, then you could look maybe towards a more growth-orientated fund.
Great, thanks. Yeah, and really good about the managed funds. I know with my kids, when I set them up, they had a lump sum of $500 that they put in, and then they contribute themselves to them when they get money from their grandparents or whatever, or working or whatever it might be. So yeah, that's great. Victoria, over to you. So what would be an appropriate investment if I was to sell my home when I'm in my late 50s?
Good question. Well, you've got a couple of options open to you in that situation, and it would kind of largely depend on, like as Nick was talking about, your investment timeframes. If you have short to medium term capital requirements, then a managed fund, just like Nick was talking about, would be a great alternative. However, if you have earmarked those for your retirement, then KiwiSaver, as Nick said, would be the very best home for that, or even a portion of it. Because every situation is different. And so the best thing to do is really to have a chat with an advisor, talk to them about your situation, what your goals are, what your investment timeframes are, as well as your appetite for risk. And then together come up with a perfect solution for a lump sum investment like that. Yeah,
great, thank you. And this is a very good question for my daughter who's at university, first year. So as a university student, working part-time job, what scheme should I be putting my funds into?
Well, that's an easy one, Cath. A growth fund. Retirement or even home ownership are probably a fair way off. So, of course, everyone's situation is different. A university student might be looking to purchase that first home sooner rather than later. But again, always talk to an advisor if you're unsure. But pretty much growth all the way.
Growth all the way. Okay, very good. All right. So let's have a look here. Okay, I'm going to start some of the ones that have come in a little bit later. So Nick, can we access KiwiSaver early for children who are about to go to university, or is it tied in until they need it for their first home? So for this question, I think we can presume that the child's got a KiwiSaver and they're going to go to university, may want to use the money for fees or whatever. Can they use their KiwiSaver, or do they need to wait for their first home?
Yeah, that's one of the restrictions with KiwiSaver is you can only withdraw for your first home purchase or for retirement. So once you hit 65 at the moment. So in that kind of situation, potentially if there's some other access to some other funds, you may need to maybe look at some other options there.
Yeah, I think that's right. And I think if you're looking, I think it may have come from what we were discussing before about having a managed fund. So you could save for your children's education over time in a managed funds, because then you can actually access the money when you need it. And I think a big thing to keep in mind is your time frame. So these are all medium to long-term investments, not short-term. And a question that's come through, someone has asked, should I be concerned, and I'll keep with you, Nick, while you're there, should I be concerned about the performance of my KiwiSaver funds over the last year with Fisher Funds? It seems to be better over the 5-year time frame, but looking at the 1 year, isn't looking so good.
Yeah, that's a good question. I mean, we've all been through the ringer this year, watching the balances of our KiwiSavers drop. It's never enjoyable, but if you think back to the long-term slide that Robbie brought up earlier, the longer we're in the markets for, the more likely it is we're going to see a positive outcome. So focusing more on those longer timeframes, like you mentioned there, the 5 years plus, it's a good sort of strategy at times like this. Forget about what's happening tomorrow, next month, and just think about your long-term plan for those funds. And as long as you're in for that long haul, the end result should be really good.
Great, thank you.
Cath, I might just add to that as well. Nick's spot on. It is a good question as well, because at Fisher Funds we do have a focus on investing in companies that do have a lot of growth in front of them. And what we found, again, coming back to this, this environment where interest rates have moved up very explosively. In that world, the immediate impact is that the move up in interest rates tends to have an immediate impact on share prices, and it tends to have an amplified effect on fast-growing companies, because just the mechanics of discounting cash flows from a valuation perspective of companies whose cash flows are far out into the future, which tend to be faster growing companies, that amplified effect impacts those companies more than others. What I would say is across a range of our equity portfolios, these high growth companies are actually performing really well operationally, and we think in time the earnings growth will eventually shine through. And to Nick's point, over a longer time frames, if we think out 3, 4, 5 years from now, I'm pretty confident that we are invested in a number of really, really good companies across our portfolios, and that should stand them in good stead through time from here. But it has been painful. We're invested in the investment team. We certainly are invested in our own funds, so we've been eating our own cooking. It hasn't been easy going in the last 6 months, but I think the future is a bit brighter.
Great, thanks, Robbie. And while you're there, I'll get you to unmute yourself. Stay on the line. Yeah. So a question for you, risk management and portfolios. So how do we deal with this in Fisher Funds in terms of geopolitics?
Yeah, geopolitics is a really tricky arena because it's really hard to gauge and factor in exactly what's going to happen from a geopolitical standpoint. And there are always geopolitical tensions from 1 year to the next. This year it's been really acute, obviously, with Russia taking on the Ukraine. So we're mindful of geopolitics, but our investment style tends not to factor in too much from a geopolitical context. We're much more focused on finding really good businesses. We've got a very defined investment process that dictates how we do that. We look for businesses with wide economic moats that are run by really good fanatical management teams that have a good growth runway in front of them, and so on. And what we've found is over the time that Fisher Funds has existed, which is a number of decades now, finding those good businesses is a really good place to start from an investment standpoint, because you're going to go through good and bad economic cycles. You're going to have geopolitical tensions ebb and flow and rise and fall. And if you just ignore that and just focus on really good investments in good businesses, that wins through in the end. But we are mindful of geopolitics, and I think we've got sufficient diversification across our portfolios to ameliorate some of the rougher edges of that, depending on how it transpires.
Yeah, great, thank you. So we've got time for a few more questions here. So maybe one each or something like that. So I'll give this one to you, Nick, which is, when is the right time? Well, hopefully this question's been answered previously, but I'll throw it to you anyway. When is the right time to withdraw your funds before it becomes a total loss? And what is the process? So maybe the discussion hopefully is changed that person's mind, but
yeah, exactly. I think Robbie's explained our investment philosophy really well. We're only looking for really good quality companies. I mean, firstly, I'll probably point out that a total loss situation is extremely unlikely. You know, for that to happen, every single asset in the fund would have to go to zero value. So in the context of a multi-asset KiwiSaver fund, this would potentially be hundreds and hundreds of companies going under, in which event, you know, we've all probably got a lot more to worry about than our KiwiSaver balances. But if you do want to make a withdrawal at any time, our process is really simple and quick. You just need to complete a withdrawal form, update your ID and bank details that we hold if required, and then we're usually able to process the payment within 3 to 5 days. If it's your first KiwiSaver withdrawal, there are a few extra steps, but we can assist you with that entire process. So we'd encourage you to, you know, give us a call and have a chat with your advisor.
Yeah, thanks, Nick. And so just to clarify, that's if you're over 65 and you're wanting to take your money out, or if you're in a managed fund, you can withdraw at any time during that time period. Great. Victoria, does Fisher Funds KiwiSaver let you split your money across different funds, e.g. like a little bit in conservative, a bit in balanced, a bit in growth?
Yeah, absolutely. We can devise a bespoke strategy that takes into consideration your individual investing needs. Absolutely. Yeah, it's again a really good idea to have a chat with an advisor before you start embarking on that, just to make sure that you're in the best split for you and your personal situation.
So probably a good idea. We do have a team here at Fisher Funds that deals specifically with your KiwiSaver questions. So feel free to give us a call or flick us an email, and someone can be in touch and talk through the ins and outs of that. So fantastic. I see we've kind of got through a lot of the questions here that we've got. And if we haven't answered your question, then we will be in touch to get to answer that for you. But as I said, please feel free to contact us with any of your own questions. And a big thank you to Nick, Robbie and Victoria for answering the questions today. And thanks for joining us on Money Week. So thank you and goodbye.